Hello and welcome to Credit Matters TV. I am Violaine Grimprel from the S&P Paris office. Today we're going to be talking about S&P latest forecast for the Eurozone economy. And I'm delighted to be joined by Jean-Michel Six, our Chief Economist for Europe. Jean-Michel, welcome.
Hi.
So in the report you just published, you point out that the length and the depth of the Eurozone recession will depend upon three factors. And the first one is the condition for external trade recovery in Europe. Could you detail this point?
Well, obviously, 2012 was not a very good year from an international trade standpoint. If you look at international demand for European products, it looks like it grew about 3 to 5%, between 3 and 5%. We're waiting for the latest confirmations, which is a very low rate of growth compared to the recent past, when that demand was growing at about 8 to 10%. So that didn't help our economies, for sure, and especially those that are very export-oriented, such as Germany. We do expect a gradual recovery in world trade in 2013. In the US, where the economy should strengthen somewhat in the course of the next 18 months. There are, of course, uncertainties, as we know. And in emerging markets, we continue to receive some very positive signals from China in particular. Industrial production is accelerating. Order books are looking real solid. We think that 2013 and beyond are going to be more favorable years, if you want, where the context is going to be more bullish for European exports. That's obviously one of the prerequisites for a more sustainable recovery in the Eurozone and in Europe in general.
Okay, and the second factor you point out is the joint effect of wage flexibility and price rigidities that depress consumer demand. Why is that?
Well, a lot of focus has been put on wage flexibility since the beginning of the crisis, and rightly so. When you cannot directly affect the level of your exchange rate, which is the case of Eurozone member states. The euro is their joint currency. It's not an individual currency in the sense that you cannot influence the exchange rate level. Well, then what you have generally to do is instead to resort to what would be called internal devaluation. You're trying to achieve the same effect as with an exchange rate devaluation, but via a depression on your domestic costs. And so we've seen, since 2010, nominal wages, labor costs in general, growth in labor costs slowing, in some cases quite meaningfully, and even in some cases in real terms, wages falling also. The problem is that, meanwhile, prices remain much more sticky. You would have guessed, or expected at least, that retail prices would also adjust to much weaker economic conditions. By and large, that's not been the case. Price inflation, consumer price inflation, has continued at a clip that is very comparable to what we used to observe in 2008 or 2010. And that's disturbing.
Well, why? Could you explain us this price rigidities?
Well, of course, the first explanation that comes to mind is indirect taxes. As fiscal retrenchment came in place and various states were trying to raise more fiscal receipts, one of the ways to do that is increase indirect taxes and the VAT in particular. And that happened. It's taken place in most countries. So it is part of the explanation. But interestingly, the European Statistical Office, Eurostat, publishes monthly price indices excluding tax effects. In other words, trying to capture what is what would the inflation rate look like if you exclude the direct effects of indirect tax hikes. And if you look at that, and we've